Welcome back. New this morning, bank regulators will testify today before the Senate Banking Committee at 10 a.m. Eastern. They will talk about bank capital requirements, regulation, credit quality concerns, and potential liquidity rule changes. Federal Reserve Vice Chairman Mickey Bowman acting as one of the key witnesses to discuss supervision and regulation. Take a look at bank stocks this morning, where we are looking at a mixed story, mostly higher. In fact, you see there the 1 weak spot is Wells Fargo. Joining me now is Federal Reserve Governor Stephen Miran. Stephen, great to see you.
Good morning.
Thank you so much for being here. So what should we expect from this hearing? What is most important in terms of the regulatory backdrop at the Fed?
Sure. So if you go back to the, before the GFC, banks were a little bit more lightly regulated. And then after the GFC, we went into this, the country as a whole went into
You mean the global financial crisis?
Yeah, sorry, before the global financial crisis. Then after the global financial crisis, we started regulating the banks, and then we kept on adding more and more and more and more regulations for over 10 years. And we got to the point where the banks are just, in my view, overregulated, and that harms credit creation, that harms the ability of the banks to lend into the economy. And so I think what Vice Chairwoman Bowman has been doing in terms of right-sizing the regulatory apparatus is completely the right thing. I'm a big supporter of her agenda. We've made a lot of progress, and I think you're going to see her go into a lot more details about the progress we have yet to make coming around the corner.
I mean, people want to know what the timeline is for the release of the Basel III endgame, and I wonder how long sort of the notice and comment period takes.
Yeah, so notice and comment will take a couple months, right? But we're still working on the details of getting that getting the Basel III finalization out there. I'm optimistic that it'll be within a few months. I'm optimistic that it'll be relatively soon.
Yeah.
And then there'll be a couple months after that for the notice and comment. But this stuff is moving along. And I think people will be happy with how it ends up.
I'm wondering if you're going to have in this Senate hearing a discussion about private credit, because that seems to be one of the issues with markets in this last couple of weeks. People are worried about private credit. What is your expectation in terms of credit right now? How do regulators feel about private credit?
So, yeah, you have seen some bumps in the private credit world. I haven't seen anything yet that makes me worried about it from a macroeconomic perspective. There's always going to be defaults. There's always going to be, some obligations that don't live up. But my view is that I think a lot of the growth of private credit ties back to what we were talking about before, that we overregulated the banks, and by making it too costly from a regulatory perspective for banks to lend into the economy, you got these soaring private credit growth as a result. Credit creation migrated from the banking system to non-banks, and so we're starting to see some of those excesses, I think, get affected. But I haven't yet seen anything that sort of makes me macroeconomically worried.
There's also the issue of interest rates on credit cards. Of course, the president has asked the banks to do a cap of 10%. The federal court decision telling Illinois to ban the charging of interchange fees on taxes and tips. What are your thoughts there?
So, that is one thing that will go into monetary policy making, right? If that affects the creation of credit into the economy, then that's something that monetary policy could offset by moving the interest rate.
I see. So in terms of those interest rates, what are you expecting for the year? You've got Fed officials echoing a cautious tone ahead of next month's policy meeting, signaling there's no rush to cut rates right now, right? I mean, you had Fed Governor Christopher Waller saying his March rate decision will depend on upcoming February labor market data. You had Chicago Fed President Austin Goolsbee urging patience, warning inflation at 3% is not good enough, and cuts should not be rushed. President Susan Collins says rates are likely to remain unchanged for some time. So how will the board decide what and how many rate cuts we could see this year? Obviously, Kevin Warsh coming in at some point after his confirmation hearings, which we're expecting in March.
Yeah, so I can't speak for my colleagues. I can only speak for myself. And, I think that one thing that they have picked up on is the labor market data have come in quite a bit better lately. There's been a noticeable pickup, and I think that's a really good thing. I think it's way too early to sort of sound in all clear that the labor market doesn't need more support from the Federal Reserve. I definitely think the labor market can be supported by the Federal Reserve further. But I think one difference between me and some of my colleagues is that I don't think we have an inflation problem. I really do not think that we have an inflation problem. When I look at measured core inflation, PC inflation, running around 3%, about 0.4%, 40 basis points of that, is just the silly portfolio management fees, which is just a statistical quirk. That's basically the stock market moved up, and then we sort of think inflation mechanically moved higher. The stock market moved up in part because, among other things, AI, which of course is, I think, disinflationary, which pushes prices down by allowing the economy to produce more with fewer inputs. And so that's a very profoundly disinflationary force in my mind that is getting mistakenly recorded as inflation. Once you adjust for this mistake of portfolio management fees, once you adjust for mistakes in, I think, how we're thinking about inflation in the housing market, there's no pressures in rents right now. The pressures that are getting picked up are a result of what happened 3 or 4 years ago. Prices to me seem stable.
What about prices in grocery? I mean, you had Elizabeth Warren pushing back on President Trump after the State of the Union, saying, well, President Trump didn't mention the price of coffee. He didn't mention the price of, various grocery items that are still showing increases, even though obviously the president's efforts have reined in inflation in a significant way.
Yeah, you'll always be able to find an outlier. You'll always be able to find a good that went up or a good that went extraordinarily down. But when I look at the aggregate broadly, I don't see an inflation problem there. I don't see an inflation problem in the broader index. It is true that prices moved higher by a lot in 2021, 2022, 2023. But since then, they've generally speaking been broadly stable. There's nothing to me that shows a supply-demand imbalance that tells me monetary policy needs to hold the economy back. Therefore, I think we need to cut interest rates by about a point this year.
A point means what?
1%.
3 to 4 yes, I know, but meaning 3 to 4 cuts?
4 cuts.
Yeah,
I think 4 cuts
25 basis points each.
4 cuts, I think, are appropriate, and I'd rather get them sooner than later. But I think 4 cuts are appropriate this year.
Especially if you see unemployment rising and job creation being questioned. I understand unemployment rate has been going down, and we had a great jobs number as the most recent. But there's a lot of worry around AI. Even Fed Governor Lisa Cook warning that AI could drive unemployment higher, saying that the Fed may not be able to offset AI-driven job losses with traditional rate cuts without fueling inflation. We've got the Fed actively deploying AI internally, from coding assistance to system-wide platform for staff. Stephen, what's your take on this worry about AI efficiency replacing jobs? The CEO of Microsoft AI said 50% of white-collar jobs will go automated within 1 to 3 years. I mean, this is coming at us fast.
Yeah, so technology has always destroyed jobs, but it's always also created new jobs. We've got thousands of years of technological progress behind us, and we always create new jobs. I don't know why this would somehow be different, that AI wouldn't also create additional jobs or create capacity for additional work. That's just how things have always gone. And so the notion that thousands of years of human history are suddenly, of economic history, suddenly are irrelevant and we can't learn anything from what happened before seems to me to be a little bit strange. I do fully expect AI will destroy some jobs, but I also expect will create entirely new categories of jobs we can't think of yet. And it's part of the Federal Reserve's job to ease that transition, to create an environment in which those jobs can be created.
All right, we're going to be watching your work, Stephen. It's great to see you this morning.
Thanks.
Thank you so much. Stephen Miran, Federal Reserve Governor. We'll be right back.